At the intersection of heavy industrial manufacturing and precision engineering, the margin for error is essentially zero. Machines that build other machines must perform flawlessly. Macpower CNC Machines Ltd manufactures these high-precision turning centers and robotic automation systems. Today, the stock is trading at 1,534 rupees and 90 paise. The market has richly rewarded their operational execution. Over the past 12 months, the stock has posted a 52.7% return. Zoom out to a 5-year horizon, and that return explodes to 760.9%. Yet, running this asset through a rigorous quantitative screener yields a highly specific cautionary flag: strong performer, getting expensive. A highly profitable elite company does not automatically translate into a highly profitable trade at its current market price. To understand why, we have to unpack the underlying algorithmic data. Trendline's quantitative models evaluate assets through a 3-pillar framework known as DVM: durability, valuation, and momentum. Each pillar isolates a different market reality. Durability audits fundamental financial health. Valuation measures historical price fairness. Momentum tracks the immediate psychology and capital flow of the market. Looking at this diagram, Macpower produces a highly asymmetrical footprint. The screener calculates a durability score of 85, a momentum score of 72, and a valuation score of just 34. We are going to deconstruct this specific 85, 34, 72 footprint. By isolating each data point, we can see exactly how the algorithm weighs pristine financial health against the risk of an overextended price multiple. Extracting the math behind these scores allows investors to separate actual operational strength from the gravitational pull of market hype. The foundation of Macpower's profile is its durability. A score of 85 out of 100 places the company in the highest possible tier for financial stability. This chart illustrates the operational reality driving that score. Notice the steady, stair-stepping climb of operating revenue and net profit, culminating in a trailing 12-month revenue of $367.8 million. The percentages validate this scale. Year-over-year revenue expanded 27.2%, and net profit growth hit 33.4%. That growth is being captured efficiently. The company is extracting a 19.3% return on equity and a 26.2% return on capital employed, indicating management is effectively turning reinvested capital into raw profit. The screener also detects a high Piotrowski score, confirming the firm is generating stable, increasing cash flows from operations, with effectively zero long-term debt to drag on the balance sheet. Within the general industrial sector, this 85 durability score ties Macpower for the absolute highest rank among its peers, sitting level with massive legacy operators like Cummins India. The fundamental data is unequivocal. This is an operationally elite growth engine operating with minimal leverage risk. The market's psychological response to that growth appears in the momentum score. At 72, the asset is flagged as technically bullish. This candlestick chart maps the current price against 16 distinct moving averages. At 1,534 rupees, the stock trades strictly above every single line, from the tightly wound 5-day exponential moving average down to the 200-day simple moving average. Trading clear above all short and long-term averages confirms a total uninterrupted structural uptrend. Buyers are consistently stepping in at higher and higher bases. But algorithmic friction begins in the momentum oscillators. This gauge panel shows the relative strength index at 71.2 and the money flow index spiking to 89.4. An MFI approaching 90 is severe, indicating the asset is violently overbought and capital volume is nearing total saturation. When oscillators stretch this far into the upper bounds, they act as statistical tripwires. They signal that the asset is running out of fresh buyers to sustain the vertical climb. The structural trend remains bullish, but the momentum mechanics are stretched to their physical limits. The asset is highly exposed to a rapid technical pullback. The tension between the pristine business model and exhausted momentum is resolved by the valuation score. At 34 out of 100, the screener firmly categorizes the stock in the mid to expensive tier. We can see exactly why by examining the historical price-to-earnings chart. This horizontal line marks the current PE ratio of 39.5. The algorithm calculates that Macpower has spent 68.2% of its historical trading life below this current multiple. Quantitative valuation models rely on historical mean reversion. When trading this far above average, the math assumes the easiest gains are already extracted. Statistically, it is more likely to revert towards its mean than expand into the stratosphere. This creates the primary algorithmic caution flag. There is, however, a mathematical counterweight to this risk, the PEG ratio, which divides the high price-to-earnings multiple by the company's actual earnings growth rate. This table reveals a critical detail. Despite a high absolute PE, Macpower maintains a trailing PEG ratio of 0.8. A PEG under 1 indicates earnings outpace price. If the company sustains its 33% profit growth, this 39.5 PE is mathematically justified. The low valuation score isn't declaring Macpower a bad company. It simply confirms the stock is priced for perfection, and any misstep in future earnings will be punished heavily. To see how these conflicting metrics finalize into a single output, we turn to the platform's binary checklist. The dashboard returns a final pass rate of 78.3%, with the stock successfully meeting 18 out of the 23 rigorous criteria. Looking at the breakdown, Macpower successfully clears every single financial health check. Consistent profit growth, robust sales growth, maintaining low debt, and strong net cash flow all pass without friction. The failures are entirely clustered in the valuation column. The stock explicitly fails the historical PE and price-to-book affordability checks. There is one additional point of failure in the ownership data. Foreign institutional investors have decreased their holdings from 1.11% to 0.57% over the last quarter, indicating that institutional capital is hesitant to add exposure at these price levels. The checklist mathematically isolates the exact nature of the trade. The underlying industrial operations are flawless, but the current entry price carries immense historical friction. When the quantitative algorithm synthesizes 85 points of durability, 72 points of momentum, and 34 points of valuation, the resulting verdict is exact. Strong performer, getting expensive. Macpower CNC Machines is an operationally dominant asset, generating heavy profits while riding a wave of extreme technical demand. But the math requires discipline. Allocating new capital here means fighting against an exhausted momentum gauge and a historical PE multiple that is highly vulnerable to compression. The objective of quantitative screening is not to predict the future. It is to accurately calculate the price of risk in the present. And right now, perfection has already been priced in.